Hi, everybody. Welcome to Friday. Looking forward to our session as always. Give me a moment to get my video show set up. There we go. Uh, excited to be here and to see those of you that are here so far as well. Hope to have another really good session today, and invite you to add any comments, thoughts, questions that you may have in the chat area of the live stream. I'll be watching that throughout the course of the live stream today, and be able to address questions and comments as they come through. Those will help to keep things lively and make sure that even though I'm the only one talking, all of the ideas and concepts we talk about aren't exclusively coming from me. As always, just really like to thank you for your time and for being here. If you're watching this after the fact, then I also want to thank you for that. Whether you're live or not, being able to share this information with you is something that I really enjoy. Just really quickly, by way of review, uh, everything that you do have access to in with as it relates to Rebel Income is available on Discord. I've pulled up my Discord server here on the screen, and just I want to emphasize a couple of specific areas. One is the live webinar. This is where you are going to see the link for this session every Thursday. Is when I post this. I have to create the link new in YouTube every time. I can't set it up as a recurring event, so I set that up on Thursday. Post the link here in the live webinar channel, so that you have plenty of time to find it and come in and join me. The trade alerts that you're going to see every week are posted on Tuesdays, and those are posted in the trade alerts channel. And so that's the primary channel that you'll most likely be paying attention to most often. And that's where you're going to see the three different alternatives to each trade that I highlight, whether it's a put sale, a bull put spread, or a covered call. You'll also have access to download a PDF version of the article if you want to read more details, get the real kind of the full skinny on the entire analysis that I do for that trade. Another area I want to highlight is the open discussion area. This is an area that I've created just exclusively for members of the Rebel Income community to be able to coordinate, collaborate, and communicate with each other as well as with me about what's going on, whether it's in the broad market, specific trades that we're looking at. And I want to try to encourage you as much as possible to take advantage of that tool. Okay, enough about that. Let's go ahead and dive in. It is Friday as always, and that means that there's always options that are expiring on a weekly basis in the United States. The most of the trades that I have in the market right now are really not set up. The earliest expiration I have coming up is for next week. A couple of prior put sales that I have on Hormel and Nike. So we'll get to those in just a minute. That doesn't mean that there aren't other things going on with other stocks that I've been holding for a while from prior put sale assignments, those kinds of things. So we'll have an opportunity to get into those. Also, hope that those of you that are here, that maybe you've loaded your you've got some stocks in mind that perhaps you might like to take a look at. I expect that we'll probably have some time towards the end to be able to open things up and possibly take a look at some things that you may be interested in that may not have crossed my desk as far as the trades that I'm looking at for Rebel Income. So we'll see how that goes. All right. Really quickly, though, I do want to, before we jump into specific positions, I want to pull the curtain back a little bit, and I want to talk about the broad market and the current conditions that we're seeing right now. As things are, it's been interesting pretty much, not just since the beginning of the year, but really since early December, to see the market appeared to be really intent on pricing in certain bullish expectations. And as a result of as a result of most of those expectations, we're seeing the we saw the indices really push very steadily towards a lot of extended highs. And here's my drawing tool, so we can see this trend continuing. My line's ugly, so I apologize, but here's where the market peaked at about 6,100. This is the S&P 500 index. This is the ETF that is tied to it, but that correlates to about the 6,100 level, and from there it's been picking up a little bit of bearish momentum, especially the last few days. We've seen, in fact, one of the interesting things is that it looks like there's a pretty major support level here. What is this? Probably around 5,800. There's about 58. There's a low here about 5,800 that looks like it may be breaking. So we're looking like we may be seeing bearish activity starting and momentum starting to increase in the market. Barry, I don't know how strange snow is to you in Atlanta. I'll be honest. I've only been in Atlanta when the weather was really, really nice and it was beautiful and I loved it. I have no idea what winter is like there. But yeah, we're used to snow. I'm actually surprised we don't have more snow where I live in Utah. So far, it's kind of been my wife's ideal situation. She likes to see snow in the mountains, but not in the valleys. And that's what we have so far. But it is really, really cold. She was looking at other areas of the country like Missouri, Georgia, et cetera, and seeing that you had snow. So I'm a little jealous. I'm not going to lie. I'd like to be able to build a snowman with my granddaughter. All right. In any event, it does look like we can see that bearish momentum is starting to increase a little bit here. What do you think about what the market has been doing the last few days? Are we seeing? Is this a sign of more alarming things to come? What do you think is a reflection of what we're going through here? Very common, not too common here in the South. So that's kind of what I assumed. So I'll be a little bit jealous. I'll go ahead and I'll be a little bit jealous of you today. What about market momentum? Is this something where we should start to be a little bit more concerned as we see that it looks like bearish momentum is starting to increase? We can even expand this view a little bit. Give me a second. Let's go to, you can see the same thing happening with the Dow Jones. Again, here's where pretty significant support is, and we see momentum today clearly picking up. Got the Dow Jones is down about 2% so far. And here's the NASDAQ. Doesn't look quite as severe, perhaps, but again, still also a break below support. So all three major indices look like they're breaking below support right now, maybe picking up some bearish momentum. What is driving that? What are your opinions? Let's get some thoughts. As I was watching some of the market news this morning, as I was prepping for this session, I saw a lot of discussion was focusing on Southern California and the fires in the Los Angeles area, and my heart certainly goes out to those people that are affected in those areas, and I hope you and your families are safe. But there's a discussion about the economic impact of that of those wildfires. And I think that may be one of the things that is weighing right now. The last number I saw estimated losses just in that area of the country at about $20 billion, which is amazing, and not in a good way, obviously. Um, does beg some questions as far as what that may do to constrain uh, building activity, and some of those kinds of things. Once those fires are contained, you're going to have a lot of people a lot of displaced people needing to find new homes. How quickly does rebuilding start? What kind of economic impact does all of that carry? And does that possibly have some kind of a residual effect? I think the last number that I saw, again, these are just projections so far, had about 160,000 people who were displaced uh, in that area. And are they all going to be able to stay in the Los Angeles region? They were. I saw with a builder in the LA area saying that the cost of living was certainly going to increase, and things like rents were going to have to increase. Barry, I'm sure that all our insurance premiums are about to increase. That's just talking about in one localized area of the country, right? But what kind of a residual impact if a lot of these people who are displaced aren't able to stay in the LA area? They're going to have to go somewhere else. And so, how does that impact some of the other areas of the country? I think that is one of the things that is weighing on the market right now. I think some lingering concerns and questions about uh, tariffs and what we're going to see from the incoming Trump presidency are also some things that are weighing right now. Are we looking at a lot more bearishness or just simply a lot more uncertainty? One of the questions always, whenever I start to look at these kinds of things, it's, oh, Carl, thank you. So glad you're here. Police, conflicts, future anticipation of economy, natural disasters, inflation, Congress, combination of all of those things. Congress ineptness. I think that no matter which side of the political aisle you may be on, congressional ineptitude seems to be a pretty common and recurring theme. Um, and all of the uncertainty that may be associated with that, right? We continue to live in a very, very divided and divisive political environment, and I don't think that's going to change. When I start to see the markets really starting to, I'm not going to say shift bearishly, but starting to certainly increase bearish momentum, it's always important to try to put things in an overall proper context. And so one of the things that's useful for that is let's measure how far things have gone so far. So this line that I have just drawn goes from about 22,100. This is the NASDAQ, 22,100 to about 20,750 roughly. So let's do the math here. And I'm rounding up for sake of simplicity, 2750. Yeah, Barry, neither side comes across as geniuses. That is true. Okay, so about a 1,350 point slide so far in the NASDAQ. Let's divide that by that 22,100, and we're down a little over 6%. This is for the NASDAQ. This is just still pullback territory. Correction. This is not even actually a technical correction yet. That doesn't mean that I shrug this off and say, well, no big deal. But let's put this in context. So far, this is just a normal pullback within a much longer bullish trend. The next question that I'm going to ask for the NASDAQ is, if this continues, where should it find next support? Well, isn't this interesting? Let me just draw this line. Looks like it's already starting to approach it. Let's see, where's this line at? Yeah. We're only about 100 points away. Yeah, about 100 points away on the NASDAQ away from a really significant pivot high that appeared right here in July. Coincides with a lot of some pivot activity here as well. So we may be approaching support. If it breaks down below this, then it's possible we could see a drop down in here to the 19,600 level. Now that's about 3,000. Now you're starting to talk about correction territory at that point. So that could become a little bit more severe, but even corrections within longer term downward trends are pretty normal. So still not categorically bearish. All right. Well, what about, let's go ahead and go back to the S&P 500. And we'll do the same thing. Go from this peak, which is about 6,100, down to about 5,800 roughly. 300 points, and we'll divide that by 61, and we're not quite 5%, 4.9%. So again, we're still really just in pullback territory here. And if we're talking about where would next likely support be, go here a little bit, which is pretty close to the current level. Maybe here. So it looks like we've got pretty solid support at a couple of different levels, maybe 57.50 or 56.50. Either way, we're still, well off of correction territory for the S&P 500. The pattern for the Dow Jones looked a little bit more severe. So let's go ahead and take a look at that one really quickly. Here we've got from about 45,000 down to about 41,900. Okay. So 3,100 divided by 45,000, 6.88% again. So even with this one that's a little bit more severe, none of these have approached correction territory. They may be starting to get there. And so, we could see some continued downside here. For the Dow Jones, it looks like we're probably looking at if this support doesn't hold, which again, it's interesting. All three indices are right about where current support should be. And if they break down, then we're probably looking at somewhere along the lines here in for the Dow Jones. What is this, about 40,000? So about another 2,000 points down, about another 5%. That would certainly put it into correction territory. But again, if we think about the status of long-term trends, especially long-term upward trends, which we've been following since the beginning of 2023, really. Looks like we could use a 10% correction, to be honest. Looks like that might actually be healthy. So that doesn't mean, again, I don't dismiss this. I'm not shrugging it out and saying, no big deal. Obviously, this has a direct impact on current positions, and that's something that we have to consider and think about as we're talking about and thinking about the trades that we're placing and we're in right now. But what does that do? Number one, for me anyway, in terms of thinking about new trades, I think the same the same drum that I've been beating for a while now applies here. Be very careful, be very selective. Carl, I know you like to use the term targets of opportunity, right? And it's a matter, I think, of being very deliberate about choosing the targets that you're willing to act on. And that's something that you're going to see me post a new trade every week. That's what I've built Rebel Income to do. There, we may see weeks where I decide to pass on a trade for one reason or another. I've done it before. I will do it again. But that's going to just depend on what's happening in the market at any given point. Sometimes it is better to go ahead and say, nothing's happening right now. I'm going to go ahead and sit on my hands. I'm going to wait for a week or for a month or whatever it may be. Barry, last week you made a comment that you really haven't been doing anything with looking for a lot of new positions instead just trying to manage the positions that you're in. Jay has said the same thing, and I think those are the kinds of things that sometimes make sense in this kind of environment. It's okay to say, well, maybe I need to hold off for a little bit. There is a premium, I think, on being very careful, very deliberate. It doesn't mean there aren't opportunities out there. I'm finding the nice thing about the current state of the market for for a bargain hunter like me is that as stocks keep dropping, their valuations are getting better. They're getting more attractive all the time. I'm starting to see stocks that I haven't been able to work with in a couple of years starting to reach some valuation levels that are starting to become really interesting. And so you may see me start to take a page out of Warren Buffett's book. When everybody else is fearful, he's going to be looking to buy stocks. And so there's something to that about being a value investor and kind of a contrarian that is important to keep in mind. Those targets of opportunity may start to increase, and that's a nice thing when that happens. But even so, the other part of this is if you do decide that you're going to take on a new position, is always make sure that you're being very conservative with the size of positions that you're taking on. I'm trying to be very deliberate about that with every new trade that I place. Here's the last few trades I've placed. Here's one on Borg Warner. Stock was around 32.50 when I was assigned. I only sold one contract of that, so it was very small relative position. This week's put sale on Medtronic was also, one contract, a little bit higher price, obviously, but still kept the position size as conservative as I could. Here's Hormel from a couple of weeks ago. Again, one contract. So trying to be very careful about how much exposure I'm exposing each position to. It's not dismissing the risk. It's also not being afraid of it. It's trying to put it in proper context and still be able to use it in a way that keeps my account running and keeps me in the market and keeps the market working for me. If you're like me and you're not afraid of taking an assignment, then position sizing becomes really important, because in times like these, you're going to see an increase in put assignments. I mean, good heavens. Just look at what's happened lately. I've been taking quite a few more assignments than normal. Well, actually, if I go all the way back to the beginning of October, 1, 2, 3, 4, 5, 6, 7, 8, 9 new assignments out of about what is this? About 15 trades, 25 trades, I mean. So Carl says exactly right about selection process, entry, next point, as this appears that the market may increase in volatility. Yeah, so be very careful, very deliberate, and plan to be more conservative. Try to do yourself a favor instead of saying this is a really good opportunity. I love it. You're going to find some like that. I really like when this trade on CVS came up. I was kind of excited because CVS is a company that I actually like quite a bit. I was actually really glad. I am really glad, I should say, that I didn't let my enthusiasm pushed me into a larger position, because this is a stock that is significantly below the $64 price that I was assigned, and it is going to stay below that for a while. And so uh, when you keep your position sizes small, when you stay conservative, you're going to be able to weather that a little bit easier. It doesn't mean that the decline is any less severe. Here's CVS. I was assigned at 64. So, I'm in it right here. And here's the stock now with a pretty nice rally today going against the rest of the market, but it's still at around 48. Barry was assigned at 59. So Barry, you're doing better than me. Right? There's your tick mark. But this is, these are the kinds of things where when you see a decline like this, sorry, and that line looks a lot more severe than I wanted it to. But when you see this, if this doesn't feel like a gut punch, I don't care about how large or small the position is. When that happens, that's not fun. If you are over leveraged in the position, if you have too much, if you've taken on too large position, it's going to be really, really hard to think about that drop in proper context and keep everything else in mind about why you placed that trade, why you decided to get into the stock in the first place. All of those things become harder questions to answer. As things are, the fundamentals for CVS are still solid. There's some things that are going on. They're going through some difficult times. So is Walgreens, but it's still a good company. The value proposition is still really nice. So I'm going to go ahead and I'm going to ride that out. That would be a much harder decision to make if I had 400 shares as opposed to the 100 in my account now. So, okay. Enough said. I've beaten position sizing enough. I've beaten all of the other drums here enough. Let's talk about some of these current positions. Let's go back here. Let's talk about Hormel. It's interesting. Consumer staples food products. If you've been with me for a while, you know that this is an industry that I kind of like to pay attention to, and have been for most of the last 5 years. As things about whether it was related to, COVID or higher interest rates and higher consumer costs. The truth is, Barry, you trade hungry. I try not to shop hungry. I will say that, but I like this sector because the truth is, when I go to the grocery store with my wife, everything looks expensive, especially relative to 5 or 6 years ago. And so I pay attention to what is happening with my kids and my son's ability to support his own family. And I know that food costs, for example, are something that have forced them to tighten their budget's pretty tight. They have to be pretty careful, but that doesn't lessen the demand for these kinds of companies. So for me, for food products, this is an industry that I still pay a lot of attention to, because I think if you're identifying the companies that the best run companies in this industry, you're still being defensive. You're looking at companies that are going to be pretty resilient, even if economic times become more difficult. But they're also finding ways to continue to provide good value to consumers. And that includes young households with small children like my grandkids. So do I trade hungry? Yeah, maybe a little bit. But that's because the need to keep pantry stock and keep household goods in the house, those things never change. And so that's going to be one of the things that, one of the reasons that I do this. And a lot of these companies lately, again, when I say that I've seen a lot of companies that are starting to drop to levels that look really, really attractive, the last couple of weeks, a lot more of them have been in food products, which has been very interesting to see. Carl, in hindsight, can you explain the drop? Go back to CVS. I'm going to assume, Carl, you're talking about that. This was late December drop. In hindsight, it was something that was pretty uniform for well, here we go. Here's Walgreens Boots, which did see a drop, but it was already so low it didn't drop as severely. CVS saw management change. I think I can't remember if their CEO retired or simply resigned. But there was a change in management, and I think that had something to do with it. There's both Walgreens and CVS are kind of the two remaining national drugstores that are still in place, and there's a lot of questions about the effect that other competitors, big box retailers like Walmart, Costco, and certainly Amazon are having on the drugstore space. And CVS has been like Walgreens has been investing really heavily in building out the clinical side of its business. It's not just a drugstore company, but a healthcare company. That started with the merger with Aetna in 2018, and it continues. They've been building out. I think they're Minute Clinics and some of their other services that are attached to just providing primary care. Those are costly. They have cost a lot of money, and they've raised a lot of questions. Walmart's here. Barry is my winner for now. Entered into that one after the split around 61. That's awesome. Here's Walmart now, 61. Now it's at 93. Barry's a winner. So he's got two. That's smart. That's good. Long upward trend here. Yeah, this is a nice trade. How long that's going to be sustainable? Open question, right? Look at the distance here that you've got between where the stock is now and the 200-day moving average. I am not saying that it is prime for this kind of a correction. This would be a bear market if it were to drop all the way back down to the 200-day moving average. I'm not saying it's due for that. I'm saying that if we're talking about potential trap zones, it's starting to increase again. We're starting to see an exponential difference between the stock's current price, even the 20-day moving average, and the 200-day moving average. So at some point, that's going to be due for some type of a pullback / correction. But for now, you're definitely in a great spot. And even with the correction, for where you got in at 61, you're doing awesome. So, okay. Kind of bounced around the CVS question a little bit, Carl. I hope that was useful. All right. So let's go back to Hormel. And this is another one we're seeing an increase in bearish momentum here. I know you can't take analyst views to the bank, but they do keep raising the target. Yeah, they tend to do that. A lot of analysts tend to do that. The more the larger the difference becomes, the more they raise the target. Again, the contrarian in me is of the type where the more I see everybody jumping on the bullish bandwagon, the more bearish I get. The more I see everybody talking bearishly, the more bullish I get. That's me. So here's the momentum of HRL lately. Clearly picking up momentum, just dropping below 30 as of now, and starting to approach some pretty major support that happened back here in November at about 29. Put this in context to the put sale that I have. I sold the $32 strike price, and it's coming up on expiration next week. So looking like I'm going to be assigned here at 32. Last week it was a little bit below, but it was still around 31. So it's been picking up quite a bit of bearish momentum lately. That's a concern. Obviously, it looks like there's going to be a pretty significant difference if if momentum stays the way it is right now for Hormel. This could be $2 to $3 below the strike price that I sold, possibly even more. Excuse me just a moment. Sorry about that. Uh, 17th, that's this one. And I'm going to have to expand the number of strikes. Here's the 32. Now on this one, I brought in, what was it? I said 70 cents. If you're of the mindset that you don't want to, you think that risk is increasing, and certainly to the point where you don't want to take the assignment, then trying to buy this back as soon as possible may make some sense. Remember, when we're talking about American style options, even though I haven't been assigned yet, the fact that we're a little over $2 below means that I could be assigned anytime between right now and the expiration Friday. And so right now, if I wanted to try to avoid that, I'd have to pay the current asking price or a buy to close at or near the asking price, which right now is about $2.50. So I would have to absorb a loss of about $180. Remember, I sold one contract, so it'd be $1.80 difference. Thus, $180 would be the net loss on this. That would eliminate the obligation of the put sale. So then I would be able to avoid that assignment. Depending on what your mindset is, as always, you know what my thought is. I sell these contracts because these are companies that I don't mind owning. And so even with HRL down at 29, excuse me, down a little bit below 30, I should say, I don't mind being assigned at 32. You know, here's the price that I expect to be assigned at. It's a pretty significant difference between that and the current price. That is not going to happen in time for me to qualify for this dividend. You have to be a shareholder of record as of next Monday, but that's okay. Give me an opportunity to go ahead and hold on to the stock a bit, wait for it to come back. As far as dividend yield goes, if I am in it long enough to be able to take to receive another distribution, the dividend yield on this now is about 3.71%. That's not too bad. Even at 32, it's going to be a little bit lower than that, but at 32, you're talking about $1.26 per year, and so that's a nice overall dividend yield. And if it does recover at all, there'll be an opportunity to generate some dividends on my own using covered calls. We'll see how those come in. Let's see. The next one, also expiring next week, is a put sale on Nike. This is a shift away from consumer staples and into consumer specialty. And so, this is a little bit of a turn. Nike's been a stock that I've used a little bit over the last few months and done pretty well. Again, this one is also picking up bearish momentum, right? So we're seeing this starting to drop. And again, relative to 74 is a strike price that that I sold, brought in $1.06 on this for about 2 weeks. Oh my gosh. Very contrary to popular belief in the South, you need shorts to go get you need shoes to go get your food. This is true. Also contrary to popular belief when I was a kid. If I could have gone to the store in bare feet, I would have. I'm not gonna lie. Carl, I've not done it lately, but some of these fundamentally sound stocks, I've had some foreshadowing by overlaying the S&P 500 chart over the stock chart. I've not done it of late. Well, that's interesting. So let's take a look at that as it relates to Nike, because we can see this is picking up momentum. So this is in kind of the same spot right now as Hormel. And all things being equal, I don't know. It's rallying a bit today. It could continue that next week. So we'll see how this shakes out. But if these downward trends continue to hold, here's the 20-day, here's the 200-day clearly down, right? Momentum clearly down. If that holds, I expect to be assigned. Well, let's go ahead and superimpose the S&P 500. So this is the SPY, and that is interesting. So again, pretty severely oversold in the case of Nike relative to the S&P 500. It has been kind of mirroring. Look at the last. If we look here at this pattern, where it bent over and started to retrace, you saw the S&P 500 kind of doing the same thing. So while the longer term trend has been divergent from the S&P 500, the more recent pattern has been very, very much convergent, right? Again, does that mean it's going to continue to drop? I don't know. It should have really strong support down here in this, what is this, 70.5 level. Now I sold the $74 strike. That's still quite a bit below the strike price that I sold, but that also is pretty encouraging to me. If with the way that support has held here and appears to be holding again right now, then this looks pretty encouraging. And if anything, it looks like what this may do is simply continue to narrow the distance between the 200-day moving average, which is coming down, and this support. Look at this. What we have is a narrowing wedge, right? If we consider all of this consolidation that has happened since about July, where it's really just not been able to pick up any bullish momentum at all. It's mostly just, it's not exactly gone sideways either, don't get me wrong, but it has also not dropped below 70 at any point here. What we're seeing is kind of a narrowing pennant, or reverse pennant, if you want to call it that. That could mean that the consolidation in this area could continue for possibly several months. It would not surprise me to see that tighten up even more. So that could mean that if I get assigned, I'll be holding on to it for a while. Again, I'm okay with that. This is, I sold this put option on Nike with the idea that I might want to hold on to this for a little while. Interesting. There's an upgrade. Raise its price target from $72 to $90. Okay. Dividend, not as impressive as Hormel, but still enough. It's useful. So again, I'm not shying away from either of these. I very well could be assigned, but I still got the room. I've been taking some more assignments, but again, my position sizes have been conservative. They're continuing to be conservative, and so I'm not really too anxious on this one. Just to check in on this one as far as what it would mean if you wanted to try to do something about this. Here's the $74 strike right now. Remember, I brought in, if you sold this as well, oops, sorry, wrong tab. If you brought in anything close to $1.06 that I did 2 weeks ago on this, then you're in a similar position as I am. Selling at 233 means absorbing a loss of about $1.20. It's about $120. These, again, I'm not trying to minimize the impact of these, but relative, on Hormel, if I were to buy it back now, I'd be eating about $180. On this one, about $120. Combined, that's about $300. But relative to the rest of my account, if I were to do that, that's, a fraction of 1%. That becomes a lot more manageable. And this is why, if you are somebody who is trying to focus on being a little bit more active in the way that you manage your trades, position sizing becomes even more important. If you are using leverage, if you're having to use margin to place some of these trades, you have to be paying attention to position sizes even more carefully than I do, because you're going to run risks of margin calls if you don't. But this is one of the reasons the position sizing becomes so useful. Again, not to dismiss the impact of taking this kind of a loss. That's real. And it's hard to try to reclaim those, right? But the idea here is that if you do have to take some of these losses from time to time, even if you're trading on a more active basis, I've got a success rate right now running at around 97%, a little bit higher, of winning trades to losing trades, which sounds really, really amazing. If you're trading more actively than I do, you're not waiting until the expiration Friday and then taking the assignment if you have to. You're going to be buying things back at a loss more frequently. But even a lot of our more active rollers that have been in the group, they're still running at success rates of around 80%. And when you're winning 80% of the time versus about 20% of losses, and you're keeping them small like this, you're doing extremely well. Your winning trades are going to make up the difference for what you're losing on these losing trades by far. So a couple of other trades coming up here. Let's take a look just really quickly. This week's put sale was on Medtronic. So let's see how we are doing on that one. I sold the $82 strike price on that one. Even though the trading alert came out with a different at 80, this was Wednesday's price action. When I went to place the trade, was this great big bullish engulfing candle, and so I adjusted my strike price quite a bit in order to get into that one. And so it's at 80.99 right now. That means that again, all things being equal, looks like this is, if this were coming up on expiration right now, looks like I might be taking an assignment. It is still about 2 weeks from expiration, so give this to the 24th to play out and see where it lands. Barry, I started working with Walgreens in April, taking assignments at $17.50, $10.50, and $9. With premiums and dividends, my cost basis is now $11.18, and I currently have calls for all 300 shares at $12.50. That's nice. Especially with this big boost in momentum today, right? I like it. Barry's running the winner board, by the way. There you go. Call it the Ray method. Yeah, yeah. Ray Marquez, one of our very active rollers. You know, this is where you're talking about being able to tier in, right? Instead of going in with an entire position, right? You go in with all of the money that you can allocate to the trade. You break it into pieces. Especially if you're looking at a stock that could continue a long-term downward trend, that becomes really smart. And with what Walgreens is doing, that kind of bears it out right now, doesn't it? So the first tier went in at 1750, the next one at 1050, and then the third at 9. That means that with all of those, your average cost down at $1.18. This is a stock that still is continuing to pay dividends. The fundamentals are still nice, and now he's looking at you're able to bring in some income with the covered calls as well, which I love. You paid yourself a dividend there, and that came in. So earnings were announced just today. It looks like they came in very favorable, giving the stock a boost, which is good to see. So that is really, really nice. I like that. Thank you, Barry, for sharing. But that tiered method can be really, really attractive, very smart, very practical. Calls are at 1.6%, expiring in 2 weeks. So, and if that momentum continues and you get called out at 1250, you'll have a nice little capital gain to go on top of the income you brought in. So I love it. All right, got a few minutes left. I want to open this up. Let's see what other stocks those of you in the group will may be interested in. Yeah, if you don't get called out, Barry, you get another $75 in dividends. Darn it. 25 cents a share, 300 shares. I'm really sorry. Carl, am I still holding Phillips 66? No, I am not. I was called out of it at a nice price, and then it continued to go up, which is kind of the norm, right? This is a stock. I'm gonna have to go way back here, and I was working with this stock in the $50-$60 range down in this area, and it went all the way back up here again, and it's come down. I have not gone back to the analysis on this in a little while, but certainly it's far enough off of its high at around 72. Now down here around 113, it's certainly worth going back again and taking another look, seeing what those valuations are like. Energy is a little bit of a mixed bag. Carl, this is what you sold me on with the method. Yeah. Barry, I love this comment, Barry. I still have more current losers than winners, but all good companies just going through bad spells. And that's what happens sometimes. This is the broad market right now. We talked about how, over the last month or so, everything in the market has kind of been bending over a bit, right? That's the broad market right now. But also, we're talking about, just every company experiences its cycles, not only with the market, but on their own, from high to low. And so you're exactly right. This is the other reason for the approach that I take, where I'm talking about good companies that I'm willing to own It's understanding they're going to go through these bad spells, but not being afraid of those. I'm trying to take advantage of those bad spells. Hopefully when I'm buying them, it's while the stock price is going through one of those downward trends, kind of a bad spell. But if that translates to good value, I'm going to go ahead and I don't know how long that bad spell is going to continue. This is taking a page directly out of Benjamin Graham's approach to value analysis. It's not saying that the stock is going to go up right away. It's saying that if the stock is a good value today at its current price relative to the value of the business, it doesn't matter what the stock price is next week or next month or maybe next year. In the long run, the stock is going to be worth more than it is now because the value of the business, a well-run company doesn't suddenly become a poorly run company. And so if the fundamentals are there, if the value proposition is there, then you can usually ride through those. Yeah. Granted, some are duds that I got in a couple of years ago when I first started trading, hoping to get a temporary spike to reduce my losses. And we all have, we've all done those. We've all had those. So that's the way that goes. This is why I put such a premium on trying to find not only fundamental strength but also good value. So, or tax offsets. There you go. Maybe ways to manage your tax burden, which may be also very attractive. So that's awesome. I appreciate that. All right. Carl, did you have any other questions about Phillips 66? Were there any others that any of you wanted to take a look at? All right, no problem. Really appreciate the participation today and the engagement. No questions and climbing back on the horse. Carl, I've missed you. I'm not gonna lie. I'm so happy that you're back. I love the group that we have and Barry and Jay and the rest that have been. Yeah, Jay. See, I got you. Those of you that are here that are the regulars, I love you. Those of you that are listening after the fact, I love you. Love to have everybody live that can join, but I really appreciate everybody that is part of our group. Haven't heard from Ray in a little while, Barry. He's asking where Ray is. Got an email from him when we were starting the shift to Discord, and I'm not sure if he was able to join or not. But Ray, if you're watching after the fact, love you. Hope to see you back again live at some point as well. Yeah, Carl, this group is something that is really important to me. If he can't talk, he's not interested. I know he has some other things going on. Sometimes he's not able to get on every single time. So yeah. Carl, I fear to ask about Joe. I have not heard from Joe in a while. I know that he had to pull away for some personal reasons, and I haven't heard from him since. So I'm not. I don't have news one way or another to share about him. So all right. Well, everybody, thank you again. I appreciate your participation so much. I hope you have a wonderful week. As always, please please don't hesitate to let me know if there are questions in between now and next Friday. Reach out to me directly on Discord if you like. I can respond most quickly there. If you prefer, feel free to email me. rebelincomesystem@gmail.com is the email address. My old Investive email has gone away, so please don't use that if you still have it. All right, everybody. Thank you so much. Have a wonderful weekend. We'll talk again next time. Thanks, Carl.